Wealth Nation. I'm your host, Meetu Bhatnagar, and today we have a very special guest, Dr. Miranda Phillips. Hi, Dr. Miranda. How are you doing?
Hi, me too. I'm doing great. How about yourself?
I'm doing great too. Thank you.
Good.
So, Dr. Phillips, would you like to share your journey, your real estate journey with the Wealth Nation, please?
Sure, yeah, I'd be happy to. So my journey kind of started whenever I was essentially, by all definitions, living the dream, if you will. I was what some would say at a peak of career for a physician, and this was probably about 5 years ago or so, so fairly recently. And I was a doctor, an ER doc, and taking care of patients, saving lives day in and day out, doing what most people by definition would say is the dream, making good money and just enjoying life. It was a lot of fun for me, and I was still increasing I should say I was getting promoted in leadership year over year. So I was increasing my knowledge base and my skill base and still learning and loving that. But of course, as I took on more, I kind of had this unsettling feeling that was growing inside of me. And it was just a discontent, if you will. I couldn't quite put my finger on it, but I knew that, if I'm living the dream, I should be a little happier when I wasn't depressed. But I was just thinking, there's got to be more to, life and fulfillment and joy than this. And so coincidentally, he was my boyfriend at the time. He's my husband now. Was an orthopedic trauma surgeon, and he was in the exact same boat. He was loving what he was doing, but had this growing discontent as well. So ultimately, we looked at our life and we said, okay, so what's wrong with our picture? Where's this coming from? And ultimately, we were able to pinpoint a couple of key areas. One was we weren't able to really take care of our health like we should be, if you will. We
Mhm.
worked nights and weekends and holidays, and so it wasn't conducive to good health, or at least not being able to optimize it as much as we wanted to. But they also wasn't conducive for being parents. I had a son at the time, and he had twins, a boy and girl at the time, and of course we still have them. But we are now a blended family. At the time, though, we were single parents, and our kids needed our attention. My son at the time was around 7-ish or 8-ish years old, and he was really, his needs of me were growing. And so I felt that as well. And same for my husband with the twins. So we got together and decided, you know what, we need to come up with a plan B, because this career path that we're on, even though it was our dream and we worked our whole life to get here, I don't know that this is going to be a good equation for long-term happiness and joyful living. So we took some life retreats, as we call them now, and we came up with a plan B. And our plan B, ultimately, after doing some reading and researching and contemplating, was to create passive income. And we wanted to create enough passive income that at some point our career choices truly still were a choice. And to go to work every day was a choice. It was no longer an obligation. Again, we were having tons of fun, so don't want to be misleading in that regard, but the discontent, the unhappiness, and what I would now say was probably a little bit of burnout. I started studying it a lot more, and now I help other physicians with their own discords and help them achieve what I've achieved. But that insidious, unsettling feeling was just growing. And now I know why. And we were able to address it. And then once our passive income was up higher than our physician salaries, we knew that going to work was truly a choice. And so then that passion came back. We were like, wow, okay, now we're remembering why we went into medicine in the first place. And, we still probably need to make a transition, but now there was no stress in doing that because there was no financial burden or financial stress. And, our lifestyle, we weren't going to have to, decrease our standard of living in order to make a necessary change or life transition. So that's kind of where we landed. And so we decided, okay, if we're going to get passive income, we need help because we didn't know anyone. We were friends with just physicians. That's who we
Okay.
have, been around our whole life. And so we said, okay, we need some help. So we hired a wealth coach who specifically helped us figure out a wealth strategy.
Mhm.
And we dropped 25K on that. It was a little expensive, but it was well worth it. And then
Mhm.
after we decided multifamily real estate, we hired another coach who was a little
Mhm.
over 25,000. And, and that coach helped us, or mentor helped us get on the path of doing real estate investing and capitalizing on all the benefits of it. And so, mentors played a huge role in getting us where we are today. And so now, we have enough passive income that, it's far exceeded our expectation, and it keeps growing year over year. And we are truly living our best life ever now.
Wow, that sounds so exciting. I'm glad that you are able to reach your goal. What is passive income? And could you please share how can our doctors or our wealth nation can become financially free?
Absolutely. Yeah. So the biggest difference between earned income and passive income being that whenever you earn income, we're having to trade our time for money. And if we quit trading time for money, if we decide to walk away, the money quits coming in. Versus passive income, where typically our money is working for us, or we've created an asset or invented something or acquired an asset that is cash flowing. So it doesn't need our attention. We could be off on the other side of the world if we wanted to be, and yet the money keeps coming in. So by definition, it's passive. Now, the way to get a passive income that's up as high as you want, I think really requires a all-encompassing wealth strategy. It's more than just the investment vehicle. My husband and I like to teach our clients, you're invested or you're an investor. You're typically one or the other. And, if we're as physicians, so often we get invested, which my husband and I were guilty of at one point, where, it's not our lifestyle. It's just where we've put our money into a vehicle that we're hoping will one day pay off. And so becoming an investor, though, is an all-encompassing lifestyle and has a all-encompassing wealth strategy. I think there's a lot of ways to go about it these days. However, the common denominator, the way we did it and the way we do it for our clients, is it has everything to do with education and mentorship, and then helping our clients create a team, so it's networking, learning, who I need on my team to be able to achieve the results that I'm wanting to achieve.
Awesome. Sounds great. Do you invest in stock markets, and why do you prefer in real estate investments over stock markets?
The only stock market investing I did was I played around a little bit with, what was that? It was Scott Trade. I think they got bought out, but Scott Trade a little bit. And I also had a 401k whenever I was
Okay.
working for the ER group that I was in. And so that was my exposure to the stock markets. And what I found was there was a lot of volatility. It's up,
Mm-hmm.
it's down, it's up, it's down. And sometimes we couldn't always predict if it was going to be up
Mm-hmm.
or be down. And I didn't really like that so much. As a physician, I tend to lean towards the spectrum of being a perfectionist. And so I want as much data as possible. And I want to be able to predict, what's going to happen based on my actions. And I felt like I couldn't do that in the stock market. And it also was not conducive to having tax advantages. As you know, me too, and as I think all of us as investors know, taxes, they take the bulk of our income throughout life, especially
Absolutely.
as an
I
earned
agree.
income, earner. Yeah. And so helping decrease those taxes was a huge goal that we knew we needed to focus on, especially as physicians. I mean, we were paying almost 50% in taxes. Now I know California has a little worse than us, but there's a spectrum. But a lot of people are around that. If you make high enough of an earned income, then you're going to pay more and more in taxes. So we knew that part of our tax strategy needed to be a plan that had tax benefits, and the stock market wasn't conducive to that at all, especially in a 401k. A lot of people, don't realize that when money goes non-taxed, pre-taxed
Mm-hmm.
into a 401k, and then you want to pull it out. Well, first of all, if you retire before age 59 and a half, you're going to pay an extra 10% in penalty to take that money out. And then on top of that, you're going to pay earned income. And after everything that's happened with the economy and trillions of dollars being printed, I have a sneaky suspicion that
Mm-hmm.
earned income taxes are not going to go down significantly anytime soon. And in the past, they've been as high as 80, 90%,
Wow.
around the 80s or 90s. So getting rid of those taxes, or at least, minimizing them as much as possible was a goal. And we found that we definitely could not really achieve that in the stock market, but that we could achieve that in multifamily real estate.
Absolutely. I agree. Is diversification important to you? How do you diversify?
I really like to focus on one or two specialized assets.
Okay.
So I will say that diversification, in a sense of, will I go invest in commodities, gold, silver, and then go also do some oil investing? No, I don't do that. I believe in really becoming an expert in what I'm going to invest in so that I can hedge my risk and decrease my risk ultimately. So I really focused in, my husband and I both focused in on multifamily as our main asset. We do have real estate, RV, so recreational
Mhm.
vehicle parks that we've also invested in. But the model is almost the exact same as the multifamily apartment investing. So it's still a multifamily model, but there's the RV parks. We've got, I would say the apartments are the majority of our portfolio now, but we do have some RV park, a portfolio specifically down the Houston area that we're invested in. And that one's been performing great as well. I would say we don't have a desire or goal to really venture outside of those two specific asset classes. We do like to diversify a little bit in properties. So all
Mhm.
of our eggs don't go into one basket, in one specific property. And, that's just because the economy, there's economic cycles in different markets. So different
Mhm.
markets are in, different cycle lives. And there's also the chance that, I don't know, a black swan event happens,
Mhm.
winter storm Uri, right, in
Yes.
Texas, that happens like once every 100 years.
Once, yeah.
And, it may hit you, and then all of a sudden your cash flow has to take a little bit of a hit. Well, so we've got other properties in other states that didn't have to endure that. And so they're doing just fine. And, and the Dallas properties they're still doing good. They're still cash flowing, but we realize we have to take a little bit of that capital now and do some repairs on the pipes and things like that. But no concern. And I would say that if anything, though, there's benefit in just diversifying amongst different properties, different markets, different states, just for events like that could happen.
Sounds great. So, what do you find more challenging? Is managing multifamily more challenging or the RV parks?
You know, I think that they're very similar. The RV park is a slightly different model in that there are different types of income streams. Like,
Mm-hmm.
you rent a pad, which is similar to renting an apartment unit, but then you can also, like, some of the RV parks we're invested in have water parks. So you could also
Okay.
get a day pass for the water park, or you could rent a golf cart to, use for the day, or you could buy propane. There's different income streams that come in addition to just the pad site itself that is
Okay.
being paid for by the tenants. And versus, in the apartments, there's other types of income streams, the other income line item, right?
Mm-hmm. Mm-hmm.
So there's like reserve parking, or, having bill back, on utilities and things like that. So it's similar, yet it's not. And
Mm-hmm.
I don't know that one is particularly more difficult to operate than the other. I will say in our RV park portfolio, we are not the primary operator.
Okay.
So,
Yeah.
I don't know all of the details that our primary operator goes through, but just from an outside perspective looking in,
Mm-hmm.
there's different sets of problems, but it's always very similar in that it's a long game, right?
Mm-hmm.
So cash flow is always awesome, and we get that like clockwork. But then we're really excited about the future of appreciation and increasing that NOI, and ultimately increasing the value of the property, and having those economies of scale. So
Awesome. Sounds great. So, what kind of multifamily asset do you invest in, class A, B, or C? Which is your most preferred class and why?
So I would say right now we're primarily in class B assets and
Mm-hmm.
class C assets.
Okay.
The reason behind that is because we like value add plays.
Mm-hmm.
And class A, as you know, they're typically newer assets that don't really need any value add plays. You just need to be leased up. And
Mm-hmm.
so I think, the class B and C assets we tend to flock towards just because we feel like we've got more opportunity to increase the NOI and further increase the value, and then refinance it and still keep holding on to it long term.
Absolutely. Fair enough. Fair enough. So, what all markets are you currently active in, and what are your preferred markets, and why do you invest in those markets?
We are active in Houston and Dallas as far as actively investing. We're in Houston, Dallas, Orlando, Tucson. That's it.
Oh
Most
wow,
most of our
that's
yeah
that's big.
Yeah, so most of our assets, I believe the last time I looked at them, we're around 5,000 doors is
Hmm.
what we've got. And so most of our assets are in Texas. And
Texas.
yeah, and I would say a lot of them are in DFW. But
Awesome.
again, we do have some diversification in those other markets as well. And then, why we pick those markets, there are several things we look at, which are probably very similar to what you look at as well. Me too. It's looking at growth markets, looking at
Hmm.
diversification of industry and job opportunities in that market. What the population growth is. We want there to be not only economic growth but population growth. We look at the affordability gap, and
Absolutely.
then um, and think what
Landlord
else we do.
friendly.
Yes, that's a huge one. Landlord friendly. Thank you.
Yeah.
And then, the
Yeah.
high median income, right immediately around
Absolutely.
the property as well. And so
Yeah.
we are open to all these markets. And certainly there's a few others we're not invested in yet that we'd like to get into. And so, and they have the same characteristics ultimately as the other markets. So
Awesome. What was the biggest challenge when you started?
the biggest challenge was the amount of time it took to get educated and then to build a network and build our
Okay.
team, right?
Uh-huh.
Because as a physician,
Mm-hmm.
I mean, my husband and I, we spent our entire lives doing nothing but become experts of the human body. And so anatomy and physiology and medical science was all we had ever studied. We just did
Mm-hmm.
not have the time, we felt like, to learn anything else. Our lives were absolutely insane, and there was just not the time. It wasn't until we became desperate enough and made time in an
Mm-hmm.
impossible schedule
Mm-hmm.
to get educated and then to go out and find, figure out how to get relationships and how to trust people and then build that network and get comfortable with the team that we had around us and be able to trust them. And so, I mean, that's
Absolutely.
the ultimate thing, right? Is
Mm-hmm.
whenever we partner together to do investing, if everyone on the general partner team is not trustworthy and has solid track records, then no one's going to feel comfortable. And we were the same way. We're just like, our very first investment into real estate. I think it was a $50,000. Some now seems small investment, but at the time, I remember thinking, my husband and I were like, okay, we're about to drop $50,000 into the hands, of someone that we think we can trust. We've gotten to know them, and okay, here we go. And it was kind of like jumping into a pool whenever you're still not confident you can swim yet. And so we did it. And fortunately, we did enough due diligence that we did get in with the right people. And so far, we haven't had any bad actors. And the network that we've got around us and the team that we have around us, which includes, asset attorneys and tax team and legal teams and all these things, have just proven to be ironclad and have helped us in our journey and reaching our goals.
Wow, that sounds very, very impressive. I'm glad that you are having so far, so good experience. And what is the biggest rookie mistake that you made?
So the biggest rookie mistake, I think again, we've been fortunate enough to not have made any major faux pas. I will say I look much closer at depreciation now. And in the beginning, I didn't look quite as closely to that. I was focused on other characteristics of the investment deal. The For instance, I'll give you an example. So in the very beginning, we would invest based on all those characteristics that you and I discussed already. And then also looking at what the return on investment would be and the cash flow, in the holding period. The depreciation we knew was there, but we weren't as focused on it. So in the beginning, we got into deals where the depreciation was only going to be about 40% of our invested amount. And as we started understanding more of the benefit of depreciation and how that helps us in our overall wealth strategy, and especially in our particular situation, it might not be everybody's, but for ours it was going to be huge. We started looking closer, and now the deals that we go into are over 70%. There's if it's 60 to 70%, then we look at the rest of the deal and obviously make a decision. But if it's a 60 to 70% deal and it's going up against another deal that has all of the same characteristics, but the depreciation is 85 to 90%, or sometimes we've got a few deals where we're over 100%. and depreciation, then we're going with those all day long. And, in the beginning, we definitely understood that we had to get invested in order to get started and to get cash flow and to just kind of start that snowball rolling down the hill. So no regrets for sure. I think we just, as we've created habits and as we've learned more and more, going along, we learn more and more detail now as we dive even deeper year over year.
Awesome. Sounds impressive. I was in the same boat because initially, when I started investing in apartments, the deals were not lucrative to me because I was looking at the return and I was getting better return if I invest in my own business. I was managing childcare centers, but I completely missed out the depreciation part. So when I was sitting with my CPA and paying all those higher taxes, then I realized the power of investing in multifamily.
Absolutely. Yeah, it's crazy, isn't it? It's amazing what we don't know, we don't know.
Absolutely. I agree. I agree. What are some of the rituals that you have created that make you a better investor?
I would say the primary ritual that I feel like makes my husband and I better investors now are that we always reanalyze our wealth strategy before we invest in another deal.
Awesome.
So, everybody again is going to be a little bit different and life changes, I mean, we're perfect examples of that because when we chose our career, for me, an ER doc, and for my husband, an orthopedic trauma surgeon, we were young, we were unmarried, we didn't have kids, and we had different priorities at the time, but life happened and things
Absolutely.
evolved. And so, if we had not taken a step back, which that's hard to do, right? Whenever people are in the middle of the treadmill, as my husband and I lovingly call it, as physicians, we could barely keep our head above water day in and day out. So to actually force the time to step back and look at our lives from a 30,000-foot perspective, we had to be purposeful in doing that. And it was not easy to force that time into our schedule. But I'm so grateful that we did because it changed our lives forever. And in that time, we were able to figure out, okay, we need passive income and we also
Absolutely.
need to get a wealth strategy together, not just throw our money into an investment vehicle and wait and hope that it pays us back, 10 years down the road. A lot of physicians will invest in not necessarily real estate. Now, maybe I'll stay away from naming specific examples, but investments that are only appreciation. They're appreciation only. There's no cash flow model, and it's kind of a hedged bet of, man, I hope this is as valuable as the creators or the inventors say it's going to be. And because if not, then I'm going to have my cash tied up for 5-10 years, and then maybe I get my money back, maybe I get a little more than that. But without an overall wealth strategy, they're not calculating actual returns on their investment, and they're not considering tax implications, and they're not considering their lifestyle and what the other alternative to life is. As a doctor, I think a lot of us feel like, we made the bed we sleep in, basically. We chose medicine, and it's a lifestyle, and we're committed for the rest of our life. And the idea of thinking about not doing the traditional practice of medicine, or the idea of only doing it part-time, is, it's almost taboo to even mention it or talk about it. But
Mhm.
I think that, for the physician clients that we've mentored, it's almost an awakening to say, look at how life could be. Here's
Absolutely.
how you could
Mhm.
be living life. If you have kids, and you want your nights and your weekends and your holidays back, and you want to be able to travel, and you want to go to every school event they have, or you want to be able to take them, to school in the morning or pick them up in the afternoon and have that valuable bonding time where they like to tell you about their day and talk about random things, you can have that and still have the same lifestyle you have as a physician, in so much as, nice house, nice cars, have a vacation home. Like, you can create that. I think it's just so many physicians, among other working professionals, that just don't realize that until someone kind of wakes them up and says, let me show you that there's other options out there.
Awesome. Sounds great. What is your hold and exit strategy? Like, do you hold it for long terms or particular years you go execute your business plan? So, what's your strategy over there?
We love the fact that multifamily real estate has multiple exit strategies.
Mm-hmm.
So as we can hold it long term, or we could sell an asset, or we could refinance. an asset and let it, cash flow forever and turn into infinite cash flow, at times. I think it really depends on the deal, but I would say in general, we really target a 3 to 5 year holding period. Now we don't want to sell in a soft market, obviously. And, if the market's getting heated up and the opportunity presents itself to go ahead and sell, for an even higher value than what we'd expect, then we certainly don't snub our nose at that opportunity. I would say in general, though, we really appreciate the concept of velocity, which of course, is getting your money back in hand and then being able to redeploy it, buy more depreciation and go create more cash flow into another asset. And so we like getting cash back in hand just so that we can redeploy it and capitalize on that velocity. So in general, I would say 3 to 5 years is our strategy. However, if we have a really solid cash flowing asset, then, in that 3 to 5 years, there may not be a sell. It may just be a refinance so that we can still continue to capitalize on that cash flow and still deploy that money off into other assets and buy more depreciation.
Sounds great. What is one book that you would recommend to our Wealth Nation?
Well, I'll tell you, I think so many of us probably have the exact same book that we recommend to people that are being introduced to passive income for the very first time, especially if they're W-2 income earners. And so there was the one that completely changed my life and was introduced to me by a friend of mine by the name of Dave Scott. And he was a physician that was also, he's such a great guy and a very mentor type of person to me at the time. He was in a leadership in the kind of C-suite, as we call it, and that's kind of like, your CEO, your CMO, Chief Medical Officer, your COO. So he was in the C-suite of our emergency medicine group at this time. And he and I talked frequently because, we both enjoyed flying small planes. He was a pilot also. And so we bonded over that, and as well as he was an ER doc. So we bonded over that. So and he told me about a book whenever I started talking about leadership and talking about, having diversified education and business and in finance and wealth. And he said, oh man, if you haven't read this book, this is a book you need to read. And it was Robert Kiyosaki's book, and it was Rich Dad, Poor Dad, of course. So that book, whenever, Dr. Scott recommended that book, I read it and I came home to my husband and I was like, oh my God, like, you have to read this book and then we've got to do something about this. And so we took action on it. And shortly after Rich Dad Poor Dad came, Tax-Free Wealth with Tom Reelwright, who is now, our CPA as well. And
Awesome.
it was just one right after the other of getting into that space. And so for people that are not already believers in passive income or they're kind of dipping their toe into it, they're typically earned incomers, if you will, and they're curious to kind of know more, then, Rich Dad Poor Dad, Robert Kiyosaki's book, and then Tax-Free Wealth by Tom Wheelwright. And you can't go wrong with those books.
Absolutely, I agree. What are some of the tips that you would like to share with our Wealth Nation who are just starting or thinking about investments?
My biggest tips would be, it's extremely intimidating to think about it, and it's extremely intimidating to look at multifamily real estate investing and know that the minimum investment amount is typically $50,000. That's not always true. Sometimes it can be lower than that. I've seen, 20,000, but it doesn't go much lower than that. Sometimes, people can invest into REITs, which you got to be careful because a REIT is kind of like the stock market. It's just real estate backed, but you can't capitalize on the tax benefits if you invest in a REIT, but you can certainly get lower amounts of money into a REIT. But, if you're really going to go directly into the vehicle and be kind of on the inside of the deal and get all the benefits of that, typically, you're looking at about 50,000 as an initial investment. And that can be so intimidating in the beginning. And it can be intimidating to think about entrusting $50,000 into someone's hands. And so my biggest tip would be, if it's something you're considering, make the time to get educated. And the best way to do that is to find a network that can educate you. That's one thing we've done with Elite Wealth and Wellness after I retired from emergency medicine, it was January of 2020, actually, right before
Wow.
the pandemic hit, ironically. And I swear I didn't see it coming, but I'd retired then, and I transitioned into lifestyle medicine and real estate professional, and it was just the best thing ever. But with Elite Wealth and Wellness, my husband and I created this network to help mentor others that are similar to us, hardworking professionals that have spent their entire lives being focused on their professional career, but they have this unsettling, discontent somewhere deep inside of them that they need a little bit of help with trying to pinpoint, and then they need a plan to be able to create their best life ever. And so, we help educate them, and then we mentor them, and we introduce them to introduce sponsors to investors and investors to sponsors, within our network, and then help them build their team. And so, Elite Wealth and Wellness wouldn't be the only opportunity to do that. There's plenty of other networks that in having more than one network, right? Diversify your
Absolutely.
exposure to different deal sponsors and to other investors. The more the merrier. But I would say getting a network that's got education and mentorship and helps you build your team, oh, it's priceless. That's the way we did it with other mentors at the time and other people's networks at the time. And I don't know how we would have done it without them.
I agree. So, Dr. Miranda, thank you so much for adding so much value to our listeners, to our Wealth Nation. How can they reach out to you?
Yeah, it's my pleasure. Me too. Thank you again for the invitation to come on and speak. People can get a hold of me through our website, it's www.elitewealthandwellness.com. You can subscribe to our newsletter. There's also a contact form that you could fill out. Just put your first and last name and email address, and there's a space for a message. So if you want to get a hold of me to ask me any questions, or if you're interested, in mentorship or education, then of course would love to help however we can. But that would probably be the best way.
Thank you, Wealth Nation. And we will see you next in 2 weeks. Until then, live a life that is filled with freedom, fun, and fulfillment.